Hi everyone. When the market falls, our instinct says stop the bleeding, pass the SIP. But is that the smart thing to do? A lot of people have come up with questions like I should stop SIP, I should not have invested in mutual funds. A lot of people panic and stop their SIPs. I looked at actual NAV data across market crashes from 2008 till 2024. Here is what I found. SIPs done during a crash can quietly outperform even longer SIPs that have been done during a bull run. So let's decode this with numbers. I promise you, it will change you the way you look at downturns. You will immediately start doing SIP after watching this video. So a 3-year SIP started at the peak of fear in 2020, gave much better returns than a 5-year SIP started in a rising market. So can you believe it? How is that possible? So let's break it down with real mutual fund numbers and you will see why staying invested, continuing investing, all these things matter in investing. So this is our topic for the day. Should you stop SIP in a falling market? This is the question that's been continuously asked by a lot of people. Let's decode it further. So SAP is a disciplined way to invest in mutual funds. SAP is systematic investment planning. You typically invest every month. A specific day is allotted, just like how your EMIs are debited from your account. Similarly, your SAPs will be debited from your account on a specific day, and mutual fund units will be purchased on that day based on that day's closing NAV. So averaging up and down will typically happen in stock market volatility. So when market goes up, the number of units you get will be very less because of higher NAV. Whereas if the market goes down, the NAV also goes down. So you can keep averaging down and make a lot of units. So instead of 5 units, you can buy 7 units. So towards the end of your investment tenure, let's say 5 years or 10 years, the total number of units will be far higher, which will eventually lead to huge, humongous returns, which we'll see in the latest part of the video through actual numbers from a couple of real mutual funds. So SIPs in India have been gaining traction and the monthly inflows have crossed 17,000 crores right now as of 2024. So this number keeps increasing and India continues to remain a phenomenal growth story in the long run. So we are a consumption based economy. So if you look at China, they are export oriented. Japan is export oriented. Korea is export oriented. If you look at countries like US and India, we are basically an internal consumption story based country. So even these tariffs would not affect us in the long run. We'll only keep growing. So SIPs only will build wealth. So you should not worry too much about short term falls like what's happening now. So this is what is happening right now. So the market fell from 26,400 to 21,800 last Monday during that crash. So people typically face a lot of uncertainty and emotional stress. So this is the most important part of investing. So if you have a strong emotional stability, you can be an extremely successful investor. You do not need a high IQ. You do not need to be a genius to be very successful in investing. So if you have that emotional capability to handle uncertainty and stress, you can be extremely successful. So the problem here is a lot of people panic and they start asking this question. So my mutual funds NAV is going down. So all of them are going down. My portfolio value is it was up 50%. Now it's down to 20%. Now it's in negative. Should I keep buying these SIPs and should I continue to have losses? This is one question. So basically, this is a short-term pain. It is just like a medicine or an injection. So over a short period of time, you have to go through this pain. So is it better to wait until the market stabilizes before continue? This is something people typically do. So the market is falling. Let me hold my SIPs. Let me not buy additional SIPs. Whenever market recovers, let me once again start investing. This is what a lot of people do. We'll get to this point in detail in the next few slides. So basically, what happens is these impulsive decisions taken by you can hurt your returns in the long term. So why do you have this temptation to pass SAP? So market crashes, they typically create fear, leading a lot of investors to pass or stop SAP. This is where you need people who can give you clarity about how previous crashes have happened, how it recovered, how have returns been. So people typically go and pass their SAPs. So the data shows that during the 2020 COVID fall, SIP stoppage ratio raised very sharply to 57% in 2020. Imagine around 1.7 lakh crore of mutual fund units are purchased. 1.7 lakh crore is invested every month. Half, more than around 60% is stopped in 1 year in a specific month. Imagine the amount of money that is not getting deployed. So, and there is another category here. So, some people at that loss will start selling everything. So, they exit at the worst time, missing the recovery rally. So, they buy at high and then they sell at lower price points. They incur a huge loss and then they go away from the market. So, this is another category of people who also do a very big mistake. So passing your SAP is basically an emotional decision. So if you leave your emotions aside, and if you think logically, you would continue to hold on to your units, and you'll continue to increase your SAPs. So it can actually hurt your long-term returns. Now let's see what rupee cost averaging is. So it is the SIP method where you average when the rupee goes down. Basically, when your NAV of when your mutual fund value goes down, you keep adding more, which will result in an increase in the number of units. So basically, it gives you a huge opportunity. A downturn gives you a huge opportunity to accumulate a lot of wealth at lower price. This is exactly like a discount sale, which is happening in a Flipkart, Amazon, or a shoe mart, like a Nike would throw away 50% discount, and then you'll have textile shops. If you go there, ready-made garments will be available at 50-60% discount during year-end sale. It is exactly like that. So you'll wait for a year-end sale and buy a lot of dresses. It is exactly like that. You will always wait for that. So similarly, downturn is actually an opportunity to buy mutual funds at a discounted price point. So historical data shows markets recover, rewarding disciplined investors. So stopping SIPs can actually reduce long-term gains and it can delay wealth creation. So here are three scenarios. So there is one person A who passed SAP during downturn. So his 3 lakh only became 3.5 lakhs and he has an annualized return of 5%. And then there is another person B who started SAP during a downturn. So if you have not invested in mutual funds, if you have never done that before, this is the best time to start investing because the market has crashed and all the mutual funds are available at a cheaper valuation. So someone who started during this downturn has seen a portfolio rise of 1 lakh and an annualized return of 8%. There is one more person who continued his SAP through downturn, going through all the pain, all the emotional aspects. He also had it, but still he went through all of that and continued to invest in SAPs. He firmly believed in investing in mutual funds, basically. This annualized return is far better than someone who's passed the during the downturn. You can see the difference: 3 to 3.5 lakhs, 3 to 4.5 lakhs. Look at the difference. If you stop your SIPs, this is what will happen. You'll miss out on wealth creation opportunities. You'll miss out on opportunities to make a lot of profits. All your primary aspect of retiring early through investing in mutual funds, dividend stocks, all of that will take a toss if you stop SAP during a downturn. Now, why people stop SAPs? That is when markets fall. So typically fear takes over. We think so. This is one important proverb that one of my friends used to keep saying. So trees can't grow beyond the skies. So after a certain level, it has to stop growing. Similarly, markets cannot keep going on in a short period of time. Similarly, markets cannot keep going down forever. So if there is a fall, it has to eventually come up. So people think, why should I invest in a falling market? So let's stop for now. Maybe I can restart later. Market crashes do not last forever. Previously, it used to be 1 to 2 year opportunity to buy. Now it's like 1 to 3 months. Beyond that, crashes do not last. So whenever there is a crash, it is actually an opportunity to make more money. Whereas if you stop and wait for a recovery, maybe if you are a seasoned investor investing in direct stocks, you can do that. Whereas if you are investing in mutual funds through normal SAP, the best thing to do is continue your SAP without stopping. So because by the time you restart, most of these cheap prices are already gone. The discount sale is over. So December, January, year-end sale, January, February. After that, you'll have new goods coming in at newer price points. So that is exactly what will happen. If you go after, so even now, right? So the Nasdaq index went up by 10% yesterday after Trump revoked the statement and said that there is a 90-day pause. So if something like this happens, the market is going to run up. So Nifty will go up by 500 to 800, at least 800 points tomorrow. So when this happens, you are actually missing out on opportunities to buy in the last 1 month. So I'll give you one more example. So in 2008, markets crashed 60%. By 2010, they had doubled. So you can see the numbers, right? So within just 24 months, not even 24 months, in the early part of 2010, it just doubled from these levels. So if you had started investing here, it would have doubled. If you had continued investing here, it would have given you a great return. If you had stopped in 2008 and then if you had started investing again in 2010, you're basically losing a lot of profitable returns in your portfolio. So you're missing out on huge gains if you stop SIP now. So if you're investing in mutual funds in a regular manner, don't stop it. Continue to do that. So in the next video of this series, we'll take two real mutual funds, HDFC Large Cap Fund and Sundaram Mid Cap Fund. I'll basically go through the numbers across two different situations, and I'll tell you who made how much money, what kind of returns happened if someone had continued to invest in a fall, if someone had stopped SAP during a fall, and if someone had started SAP during this fall. So we'll continue this in the next video of this series. If you like this, if you like this video, subscribe to our channel. Uh, Keep waiting for the next video. You can share this with your friends as well if you find it interesting. Thank you. Happy investing. See you in the next video with detailed analysis.